Hey everyone, this is On the Money. This is Matt Stevenson, president of Allied Wealth. Really wanted to walk through a recent client example that came into our office, Bob and Linda, here within the last couple of weeks. What Ryan and I did for them is what we call a portfolio X-ray. Bob was looking to retire from his company within the next couple of months, really just giving them more insight and education into how that 401k was positioned and give them the confidence that they could retire and live the lifestyle they want to in their golden years over the next 20 to 30 years to come. What you'll see as we walk through here is really an example of identifying whether our clients are on the right track already or if there are a few tweaks that we can find and implement together and bring value to their lives in retirement. As you're watching the video, click the like button, hit subscribe. We'll have more content each week for you to follow along with us. Well, as we'll walk through here, we'll see that one of the first things that we do is really just build in the set of investments that our clients have. So this is Bob and Linda's portfolio. They're with the 401k. And here you'll see all the different funds, stocks and mutual funds that they have in the portfolio. So most of this is going to be mutual funds, and really all a mutual fund is a basket of stuff, whether it's stocks and bonds, real estate, really anything of interest for you to help you diversify and get your money working in the right way for you. Also see some company stock here. So really the combination of all of this, Bob had built about $1.1 million within the 401k plan. This, in addition to his company pension, sets them up well for retirement, really looking to get a second opinion on making sure they are indeed on the right track for success. So once we have those positions built in there, the next step that we want to do is really identify what we call a benchmark. And what a benchmark is a set of comparisons that we can make to the investments we have in the nest egg. And we can measure our benchmark on what we call a risk versus return scale. So that scale moves out from bottom left to top right, where the most aggressive portfolio would be there at the top right, should get the highest return over time, but will also likely be the most on the emotional and monetary roller coaster over the years. On the flip side of that, this most conservative portfolio would be here at the bottom left, potentially giving up a bit of return expectation over time, but should also give us a bit more stability. And we can use this same scale to identify that benchmark or our direct comparison for the set of investments that we have. And we do that by looking at the mixture of stocks and bonds in the portfolio. For instance, our most direct comparison for this bubble or portfolio on the top right would be 100% stocks. And a good proxy for that is the S&P 500, our stock market here in the US. As we move down this scale, traditionally what we have to do to de-risk a portfolio is add bonds into that mixture. So for instance, the next bubble down would be what we call an 80-20 portfolio. And that simply stands for the percentage of stock, here representing the 80%, and our percentage of bond, representing that 20%. We can pause, in fact, right there because we've already identified Bob and Linda's benchmark, that comparison that we can make to their portfolio as the closest benchmark based on their stock and their bond mix is that 80-20 portfolio. So as we'll see over the next few minutes, we'll refer back to that several times and really tie how their portfolio is positioned into the overall plan that we want to build with them and identify if that's comfortable as far as their tolerance for risk and what we call their capacity for taking risk, or how much can they afford to lose in different market environments. As we scoot down here through this analysis, we'll also see something very interesting in that we can actually quantify and break down the style of the stocks that we're invested in. And we can do this by large cap, really those S&P 500 companies, mid and small cap companies, more growth oriented over time, and by value, blend, and growth orientation. And what we see here is that there's a pretty heavy concentration in those large cap growth stocks. That's not uncommon, folks. We see that with most of the portfolios we analyze. This is one of the ways that we measure diversification within the portfolio, with the understanding that stocks themselves are one category of investments, but really one tweak that we considered with Bob and Linda to implement together is simply diversifying away from such a heavy concentration of large cap stocks into some of those mid and small cap companies as well, to give us some of that diversification that we need. That also over time helps to lower our risk profile. This is something that we don't really think about very much. So we see this area called regions of our investments. And I like to talk about this with clients because this refers to what we call home country bias. And guess what? We're all guilty of it, no matter whether we live in the US, China, you name it. And so what we find is this phenomenon that most people invest about 80 to 90% of their retirement dollars in companies of their own country of origin. So Bob and Linda, no different in that regard. They've got about 80% of the portfolio allocated to North American companies. And I believe that this is the greatest country on earth, but this is another way that we can measure the true diversification of the portfolio. Once again, simply looking for small tweaks that we can make here to allocate some dollars to other regions, perhaps some international investments here, again, to get a good return and perhaps lower our risk profile in the process. Really what we'll get into here is some of the meat of what we want to cover in this analysis, which is truly figuring out how the portfolio has been working for you over the years. And anytime that we measure a set of investments, we want to keep this idea of time horizon in mind. And what this means is with any investment that we have, how long should we need to invest in that way to see the results that we're looking for? And if we use the stock market, the S&P 500 as a good example there, well, the market cycles tend to last quite long. In fact, 10 to sometimes 30 years in time is what we see most often. And that seems like a really long time, folks, but in fact, we're experiencing that in our market environment where we sit today. So if we go back to the beginning of the century in the year 2000 and flash forward to where we sit right now in 2022, well, it's been a wild ride for the market over those years, to where not only at the turn of the century with the tech bubble crash in 01-02, certainly we had the significant downturn there with the global financial crisis in 08-09, and of course very recently with the pandemic there in spring of 2020, we've seen 3 huge market downturns just within the last 20 years. And even this year, to start 2022, we've seen some sizable downturn in the market. And so, especially on these first 2 occasions, the stock market had a loss, or what we'll call drawdown, you'll see that more in a moment, of more than half of its value. And at the onset of the pandemic, the stock market had a downturn of about a third of its value in 4 short weeks. And so this is the roller coaster that we can find ourselves on, but that's exactly why we have to measure our set of investments over a long time frame to see those results that we're looking for. Now, with that in mind, the first thing that we're going to do is look at the sort of return that Bob and Linda have been getting over time. This is where most of our focus is what sort of growth are we seeing over the years. And true to form, we want to measure this over the longest time frame available to us. In this case, we did go back to the turn of the century. So about a 20-year time horizon there. They're on the far right column. And what we found for Bob and Linda is that their portfolio has averaged a growth rate of 6.7% over that nearly 22 years of time. To compare that for a moment to, say, the S&P, has averaged about a 7.5% return over that same time frame. So we're getting a little bit less return than the market overall over that 20 years of time, but that's also half of the equation that we need to consider, especially as we get close to retirement, because we need to get a handle on the level of risk that we're taking with our dollars in retirement. And we can quantify and measure risk in terms of standard deviation, or what we call wobble factor with our clients. And all standard deviation simply means is how far above or below our average annual return our retirement dollars should move in a given year. And so that's expressed as a percentage. Here, again, on the far right column, we see that our standard deviation for Bob and Linda is 12.4. Now, again, to have a comparison for that to the stock market, over that same time frame, the standard deviation or the risk factor of the market is about 14%. And so while we're getting a bit less return than the market, Bob and Linda are also seeing slightly less risk in their portfolio. And so that really aligns with the benchmark that we saw, that 80-20 blend just a moment ago. But oftentimes, one of the most important numbers that we point out to our clients, and Bob and Linda in this case, is in fact this last row, what we call drawdown. And folks, when we talk about drawdown, we're really talking about our potential for loss in the portfolio. So one of the questions I ask clients all the time when they come to visit with me and we're getting to know each other to build a plan is really, Bob and Linda, how much of your life savings are you willing to lose today? And for most of us out there, that's likely none at all, right? But this ties directly to a conversation about understanding your tolerance for risk, how conservative or aggressive you feel that you can be, but also your capacity for risk and how much you can be willingly lose in different market environments. What we found for Bob and Linda in this case is that over a couple of different periods of time, their set of investments would have lost 41.5% through those 01, 02, specifically 08, 09 downturns in the market. Bob and Linda were absolutely shocked by this number. And to put that in perspective, for easy math example, as I drew this out for Bob and Linda, let's say we have $1 million portfolio here. Of course, it's slightly higher than that, but if we experience a 40% downturn on the portfolio, that $1 million nest egg that we've worked so hard to build over the years now turns into $600,000 within the blink of an eye. And this is extremely important to discuss because once we get into that retirement window, it's about how do we turn these dollars that we've saved to prepare for retirement into a paycheck replacement that we can outlive over the next 20 to 30 years to come in our golden years. And so one of the things that I stressed to Bob and Linda is that if we have $1 million here with the nest egg and we're looking to generate, say, a 5% income or distribution rate off of that portfolio, well, 5% of $1 million would be $50,000 a year, which, given Bob and Linda's pension, in addition to their Social Security benefits, set them up to produce about $140,000 a year in income in retirement, which positions them very well. But one of the things that we noticed is that if we do experience this drawdown in a severe market downturn, we still need to generate the income off of the nest egg to live the life that we desire. And so a 5% distribution rate on $600,000 is much different. Now our income has been chopped from $50,000 a year to $30,000 a year. And this would be a situation, as it turns out, where Bob and Linda would have to make some changes to their lifestyle. And so, folks, when we visit with you in our office and we're getting to know each other, building a plan, going through this portfolio x-ray, this to me is one of the most important numbers that we'll ever talk about because it's very much about staying on the right path. We hear so much about, the stock market having great years recently, 20, 30% returns, but with the understanding, folks, that there have been those significant drawdowns in the past of 40, 50%. And the late, great Jack Bogle, founder of Vanguard, would say that the typical 60-year-old today will experience 3, if not 4, significant market downturns of that size over the rest of their years. And so positioning ourselves to mitigate risk and, most importantly, draw down as much as we can, eliminate some of that variability or wobble factor from how the nest egg operates for you, allows us to create more consistent results and cash flow each and every year in retirement. And so, lastly, to tie this together, looking at our return and risk numbers from a moment ago, and I'll map this out on what we call a normal curve, going back to high school stats class for just a second. Here in the middle of our curve, I'll map out our average return. I'm an easy math kind of guy, so we'll round that to 7%. And our risk number, we see that that's 12.4. We'll round that to 12, again for easy math. So what we want to see here is creating a range of expectations for what the nest egg should do in a given year. And so in those good years, what we would do is simply add our return and our risk numbers to one another. So here, 7 plus 12 would give us a positive 19% return. A great example of this for Bob and Linda is this is pretty close to what they did in, say, 2019, even last year in 2021. But if it always worked like that, then a lot of us would be in pretty good shape. But the fact of the matter is that it doesn't. When we see these significant drawdowns in the market, such as we've seen in 2020, so far this year, even 2018 more recently, it can certainly impact the portfolio. In those years, we subtract our risk number from our return. And so here, 7 minus 12 gives us a negative 5% return. This is almost spot on to Bob and Linda's return in 2018, for example. And so now what that creates for us is a range of expectations inside which their nest egg should operate in a typical year. And so that range here would be about a 24% range from top to bottom. And one of the questions I asked Bob and Linda is, would you consider that a small or a wide range of expectations? And this is where Linda jumped in, and she said, that's a pretty wide range of expectations, Matt. Is there any way to tighten that gap? And before I went to answer that question, I wanted to point out, much like we did with our drawdown conversation, that when we see these impact events in the market, we unfortunately have to extend the range of our normal curve quite a bit to where we've often seen markets function up to 3 risk factors outside of their typical range. And here's a great example of that, where in a year like 2008, much like we saw with our drawdown number, Bob and Linda would have positioned the portfolio potentially to lose up to 41% in that impact event. And so what that does for us in reality is it extends the range of expectations astronomically to where now our true range is from -41 to +19. Folks, that's about a 60% range of expectations for what the nest egg should do. And if Linda thought that our first example was a wide range, she sure as heck thought this was. And so one of the things that we do with our clients, and one of the tweaks we made with Bob and Linda, is focused on some of the ways that we can, in fact, hone in that range of expectations to where it's entirely possible we give up some of the market upside in those strong growth years, but we're also seeking to limit as much downside risk and drawdown potential as possible to ensure that we get the consistency that we need from the nest egg to generate the income that we need all the way through retirement. Now, one last bit of info I always like to cover when going through this portfolio x-ray, and this will look pretty funny to a lot of folks out there. It's what we call a correlation matrix. It's essentially showing us how related all of your investments are to one another, kind of like a football team, right? We've got a quarterback, running backs, receivers. We have to see how well they play together to accomplish our goals over time. And we did that same thing for Bob and Linda here. Again, mapping out the different investments they have inside the 401k plan. And really, this is yet another way that we can measure the diversification of the portfolio. For example, when we measure a correlation, it can range from a -1 all the way to a +1. Essentially, if we have a set of investments that has a -1 correlation or relationship to one another, that would mean that we have one investment that's going up while the other one is doing the mirror opposite of that, going down. And so on the flip side of that, if we have two funds that have a +1 correlation to one another, then they're both doing the same things at the same time. As one goes up, one is moving right alongside that on the way up. But that's very nice when the market's doing well for us. On the flip side of that, when the market is struggling, such as those impact events that we've seen in the past, those same investments move alongside each other on the way down. And so in fact, what we want to find and implement into a sound retirement plan are sets of investments that have little to no correlation or relationship to one another. And so what we see here are maybe we have an investment that is growing, maybe some other investments in the portfolio are moving sideways, maybe even a few of them are moving slightly downward. depending on the market situation. But over time, what this helps us to do is achieve the solid rate of return that we're seeking while minimizing risk and, most importantly, minimizing our drawdown potential over time. When we went through this correlation analysis with Bob and Linda, we saw that a lot of the funds that they're using inside the 401k have a very high correlation, that relationship to one another, which is very much this scenario, which again works very well as the market is growing in value, but it works against us when we see a lot of volatility out there. And so, folks, these are the types of things that we want to go through with you, just like we did with Bob and Linda in building your portfolio X-ray. This is really the first step in analyzing how you're currently positioned, seeing if you're on the right track already, if there might be value in partnering with an advisor, if there's some tweaks to consider, and really the next step would be to stress test that out in a comprehensive financial plan based on what you're currently doing, perhaps what you could do on your own without the use of an advisor, and what that partnership would look like implementing some of the concepts just like we do with Bob and Linda and all of our clients at Allied Wealth. Folks, this is On the Money, our YouTube channel. If you like the video, hit subscribe, hit the like button, and we'll see you soon with some more videos to share with you.